Are we headed for a recession in 2026? What markets, households, and structural shifts are telling us? Talk of recession comes and goes, but 2026 has a unique mix of economic data, market themes, and structural shifts that make the question more compelling than usual. Growth is expected globally, but that headline number doesn't capture the growing fragilities beneath the surface, from geopolitical tension to income pressures and volatile markets. So let's walk through the signals, not just the fear-mongering headlines, and unpack whether the risks this year are signs of a looming downturn or simply a shift into a new economic regime. 1. Structural risks in the global economy. A recession isn't just triggered by falling GDP. It's often sparked when confidence falters, markets tighten, and spending slows. Several big forces are currently reshaping global economic dynamics. Geopolitical fragmentation. Countries are prioritizing security and domestic resilience over global integration. Trade barriers, sanctions, and shifting alliances are changing how capital and goods flow across borders. Policy uncertainty. Investors frequently re-rate markets when political decisions introduce risk, especially around trade and military tension. Energy transition challenges. Countries are still juggling old energy systems and new renewable investments, which creates price volatility and infrastructure strain. These aren't short-lived disruptions. They're structural forces that can dampen long-term investment and slow the normal velocity of economic activity. 2. What market themes say about risk and opportunity. Markets don't just react to quarterly earnings. They also price in structural trends. According to recent market analysis from MSCI, four key themes are set to define markets in 2026: geopolitical shifts, AI investment leadership, rising energy and data center demand, and private credit liquidity risks. Geopolitical shifts. Confidence in markets is sensitive to geopolitical developments. In 2025, differences in performance between U.S. and European stocks reflected rapid shifts in investor sentiment and elevated defense and risk premiums. Higher political risk generally reduces willingness to invest in long-duration assets, which can slow economic growth. AI investment leadership. AI isn't just a tech story. It's transforming capital allocation. Firms investing heavily in AI R&D and infrastructure are seeing faster growth and commanding premium valuations. This focus, while a positive for productivity, also concentrates returns and makes markets more cyclical and sentiment-driven. Energy and data center demand. Demand for electricity, especially for data centers and AI computing, is expanding rapidly compared to broader electricity use. This growth creates both opportunity and risk. If infrastructure can't keep up, energy bottlenecks can slow productivity gains and increase input costs. Private credit liquidity risks. A growing share of credit is coming from semi-liquid funds that promise periodic withdrawals but hold long-term loans. Rising write-downs and liquidity mismatches here could create stress in risk markets, especially if a broader slowdown hits corporate credit. These themes suggest where markets are being shaped, and they reveal potential fault lines that could widen if confidence weakens. Exactly the kind of dynamics that often precede a recession. 3. Short-term signals. Energy demand and market sentiment. One of the most interesting and timely data points comes from U.S. natural gas storage reports. In the week ending January 16th, U.S. energy firms withdrew 120 billion cubic feet of natural gas from storage, slightly above expectations, but materially below historical averages for this period. Stocks remained elevated compared with both last year and the 5-year average, largely because warmer-than-normal weather suppressed heating demand. Markets had braced for larger draws, but demand was muted. Attention is now on the next report, with expectations that frigid weather could trigger one of the largest weekly withdrawals on record, a rapid reversal that would highlight how volatile energy demand can be. This volatile tug-of-war between weak consumption and sharp draw expectations matters because energy costs flow through the broader economy, from manufacturing to consumer bills, and can influence sentiment and inflation. At the same time, stock markets demonstrated the precarious state of investor confidence. After a sharp risk-off move earlier in the week, U.S. equities rebounded when remarks from political leadership ruled out military force in a geopolitical dispute. The S&P 500 and Dow rose about 1.4%, and tech shares led the advance as fears eased, but the underlying caution remains, because the same political actor reaffirmed intentions to pursue economic pressure on allies, keeping trade uncertainty alive. This kind of headline-driven volatility isn't typical in calm markets. It suggests markets are on edge, sensitive to geopolitical updates and policy signals. 4. The household reality. Income versus cost pressures. Macro signals are one thing, real people's finances tell another. In the U.S., median household income data shows that income levels vary widely by household size, with single-person households at around the low $40,000s and larger households climbing into the $80,000 to $90,000 range or higher. But here's the catch. Even when income nominally increases, rising costs in housing, healthcare, and childcare have eaten into real purchasing power in recent years. That means a large share of households still feels financially stretched, and when consumers feel squeezed, they spend less. Consumer spending drives roughly 2/3 of U.S. GDP. So if spending weakens meaningfully, the economy is far more likely to slow or flatten, even without a traditional recession signal like negative GDP reported in quarterly data. Weak consumer demand can ripple through corporate revenues, hiring, and credit markets, creating a feedback loop that brings the economy closer to contraction. So, recession in 2026? Here's the bottom line. The data doesn't point to an imminent, dramatic recession. Not yet. Growth forecasts remain positive, and some market indicators are constructive. But here's what is clear. Markets are more sensitive to geopolitical and policy risk than they have been in years. Structural shifts like AI, energy demand, and credit dynamics are concentrating risk in fewer, more volatile places. Consumer income gains are real, but under pressure from higher living costs. Short-term indicators like gas demand and market sentiment swings show potential stress points. That combination creates a high-risk barbell environment. One side anchored by growth themes, AI, energy demand, productivity. The other by risk factors, policy uncertainty, credit stress, income squeeze. In plain language, the economy might not crash, but it could wobble. And if one of those risk factors tips into a bigger shock, say massive credit drawdowns or a geopolitical escalation, we could see recessionary conditions develop. So rather than a simple yes or no, the smartest takeaway for 2026 may be, we're not necessarily heading straight into a recession, but we're walking on a tighter line than we have in years.